Hey, what's up, everyone? I'm Andrew Cox here for episode 35 of Great Quarter Guys. I guess this is the Kevin Durant episode if we're going to keep going with our sports numbers. I'm holding down the fort by myself today. No Kevin, but I do have an incredible guest with me. This is the Director of Passport Research, Mr. JP Hampstead, back again. How we doing, JP?
Good, man. It's great to be here. Thanks for having me on, Andrew.
Yeah, it's raining actually so hard right now that it may come through on our sound here. We've been deprived almost of our rain that we became accustomed to during the first 3 months here in Chattanooga. But I was happy that it's been sunny the last few weeks. But it is pouring rain right now on this Tuesday afternoon. So we'll hop right in. I'll jump into that Bank of America data that we've been speaking about for the last few weeks. Oh, first off, by the way, hat. Thank you, Craig Fuller. You hooked up the TV team with some very beautiful Nike hats. I wanted to wear it, and thank you for that. But on that Bank of America consumer spending data, Kevin now owes me $3. We went year over year, total card spending positive twice more in the last week. And this is the week of the 14th to the 20th of June. And honestly, it was more of the same on all the other categories. We see smashing numbers for online electronics, for online electronics, home improvement, and furniture. That is fantastic news. It's continuing kind of more of the same there. We had kind of seen restaurants start to pick back up, where we had averaged in the negative 35 to 40% range in early June. We had seen that pick up here in our latest week of data to the mid-teens down, but that kind of reaccelerated towards the end of our data. Who knows what that means? Overall, it seems that people aren't hoarding right now the way that they were back in early March. The spending at grocery stores is still up about 20% year over year when it was up very high, up 50, 60% year over year back when that first kind of panic buying started. But there that is. We will hop into our big conversation today, and the big conversation is based around a report that Passport Research put out last week. This is, of course, JP's team. They did a Q2 3PL preview. It seems all of the 3PL, all the big public brokerages, they focused on 6 of them. They will be reporting their Q2 earnings in the next 2 weeks or 3 weeks or so. So JP thought it was timely to do a little preview about margins and about what has happened in Q2 for these companies. And you really start and you open up the piece looking at the 6 largest public brokerages over the past few years. You looked at kind of the cycle that has ensued since, I guess it kind of started 2015, 2016. Give us a little bit of the cliff notes on the last couple years pre-COVID, and then we'll hop into how the coronavirus has affected the public brokerages.
Sure. Yeah. Thanks, Andrew. So we looked at data from Hub Group, C.H. Robinson, Echo, Landstar, J.B. Hunt, XPO Logistics. Over the past 10 years, looking at gross revenues, and gross margin percentage mainly. And basically, the story here really is that 2018 was an outstanding revenue year because of high volumes and high rates. Revenues have contracted pretty broadly across the industry on a year-over-year basis since the first quarter of 2019. And while revenues were falling, margins were widening in the initial stages of that down cycle. So if you think about the way that spot rates would have fallen faster than contract rates, meaning that costs were falling faster than revenues, margins widened. Then margins stagnated in the trough. Most of 2019 was fairly stable, and then started contracting again as contracted freight prices were adjusted downward to converge and close that gap with spot. So that's kind of been the story. And we've seen some, a couple companies have been able to return to growth kind of at the end of this trough, revenue growth that is, including, J.B. Hunt and Robinson and Echo. We're talking single-digit growth here. But what we were really interested in was the margin story, because if you go back to the first quarter earnings calls that we listened to, obviously all the management kind of talking about January through March and then giving updates on April trends. Those calls really took place kind of in the second and third week of April, and the market looked very different then than it does now. we had just seen a massive run up in volumes and tender rejections that kind of peaked on March or thereabouts March 23rd, and then followed by a kind of a precipitous drop in both of those measures and a drop in spot rates. And so by the second week of April, brokerage executives were feeling pretty good about their businesses. They had seen 3 weeks of expanding margins and loosening capacity, and they thought that freight markets were stabilizing, that they would be able to book trucks easily and cheaply for the foreseeable future, and that they could once again return to margin expansion. But what we found was that actually wasn't the case, that most of those calls took place kind of around the market bottom, and then volumes accelerated from there, capacity tightened from there, and rates increased from there. And kind of going back and looking at, you see like this big, the shape of the quarter is this big U-shape, like concavity, right? But if you take all of those days and you say you take it's in Sonar, it's DATVF.VNU, but it's DAT's average national spot rate. If you take that for every single day, add it all up, and you look at the same period in 2019, this quarter had higher spot rates than the second quarter of 2019. On lower contract rates, that means tighter margins. And so we think that a lot of these CEOs are going to be proven to be mistaken about the way that the market ended up playing out in the second quarter. That's really no fault of theirs. The other thing I think that's interesting, and the reason why we did the preview in the first place, Andrew, is that to the extent that these 3PLs are able to maintain their margins, it would be because they use their scale and superior buying power to push rates lower in April, and then to keep them from rising as quickly in May and June. And so we'll see kind of to the extent that companies can outperform the basic market fundamentals, we'll kind of see, how well they operated.
But let's say you're right in the fact or in the thought that the major brokerages, their Q1 earning calls happened in that second or third week of April. They were expecting wider margins in Q2. The facts and the dynamics of the industry changed very quickly. But there was something you said that it was no fault of theirs, and I wanted to kind of push back on that a little bit. I mean, is it simply that they just expected that kind of lofty freight market that they were experiencing in that first couple weeks of April to extend further on, or was that too optimistic? Like, how did they miss the mark in this sense of expecting things to be good for much longer than it actually was?
I think that when they were talking to investors and analysts on their conference calls, it was near the bottom of both investor sentiment in the space and just freight volumes in general. And so I don't think they anticipated the extent to which freight would recover quickly and then blow past sort of year-over-year break-even points again, right? And it took longer than it did in March. It wasn't driven by short-haul refrigerated loads, and consumer food hoarding. It was across all sort of, with the exception of a flatbed, which is only just now started to turn back on. Right. It was driven by dry van freight across the country, and dry van is still outperforming reefer. So I just think that the pandemic has broken down a lot of formerly stable relationships between the data sets that these executives are used to looking at, and it's just making the economy act weird in general.
Yeah, I can't disagree with that. The economy is acting strange right now. But you mentioned there for a moment about if these public brokerages are able to not to avoid the margin contraction. That that's because they were bigger and they were able to put forth pricing power. Is there any, and this is kind of off the cuff on the top of your mind, is there any of the brokerages specifically that you think are in that position to do that more so than the others?
Yeah, I think in particular, C.H. Robinson and Echo should be really good at this. And the reason I say that is because they both have, and J.B. Hunt as well, but they've both built a lot of technology and sort of internal marketplaces for freight that may be less volatile than the load boards, for example. So when I quoted the DAT spot rate, that's based on the load boards. When you look at our research and we're talking about truckstop.com rates on specific lanes or truckstop volumes on certain lanes, that's also load boards. And I think that sophisticated freight analysts think about spot in a kind of a stratified way, where there's kind of ad hoc spot markets between large shippers and their favorite providers. There's marketplaces that brokerages create for their qualified carriers. And then the load boards are kind of the most volatile of them all, and kind of perhaps...
I think you referred to it as the day of market, or somebody you quoted somebody referring it to as the day of market.
Yeah, William Kerr from Edge Logistics, he's really smart, especially thinking about carriers and the capacity market, and he always uses time preferences. So he calls it the day of market and the next day market and the 2-day market.
Right. Okay.
So yeah, I just think that to the extent that these large 3PLs have scale and have sort of internal marketplaces, they might be more insulated from the kind of frantic volatility that you see in some of the load boards with wild, load to truck ratio swings and things like that.
All right, so let's get to the elephant in the room that I'm sure people that are watching want to know, and that's how much contraction are we expecting to see? How far can these margins get squeezed when they report their earnings here in the next couple of weeks? What are you expecting?
It's going to be really hard. And I would say that Q2, I don't think is going to be the end of the story, because I just think that there are underlying capacity issues that as the economy recovers and as freight recovers will become more and more apparent, and they're not going away anytime soon. Too few trucks have been ordered, too few drivers have been added, there have been too many carrier failures, and they affect different parts of the market differently. But I think that I wouldn't be surprised to see margins negative by 100 basis points year over year, and I would think that Q3 and Q4 might be worse.
Really? Well, this is that whole capacity crunch argument that not only FreightWaves was buying into and kind of pushing forward there pre-COVID. Is it the same similar type of thing you're expecting to happen here soon after, if we don't see volumes retract a little bit off of this ridiculous surge that they're on right now? If you see volumes staying this high, do you see the outbound tender rejection index staying in the double digits for an extended period of time?
I mean, that's the big question, right? And I think in another venue, I compared the July 4th holiday to like a singularity or an event horizon that's really hard to see beyond. It's always a fundamental break point in the market where it's really hard to tell right now if we're in a seasonal surge that's normal but maybe amplified, versus the beginning of like a structural, cyclical turn in the market, right? And so I think what to look for after the holiday is how capacity behaves in relation to volume, right? And you hit the nail on the head. It's if capacity stays tight with a little bit of volume underperformance, that'll be a key that Q3 and Q4 might get a little wild.
I wanted to pose this question to you because it was something that we briefly touched about last time I saw you last week, and it was just the general idea of how volumes and rejection rates have worked with each other over the last few months. When we first saw that initial surge back in March, you saw carriers very quickly react to the surging volumes and started rejecting freight in favor of spot market loads, in favor of trying to get some extra dollars, get some extra pennies on the mile, But here in the second surge, it's been a much slower and more gradual move upward to the right. Yeah. That's something you guys speak about a lot. Yeah. So, why I'm under the belief that it actually has taken a little bit longer, probably about 2 or 3 weeks longer than I would have expected it to take for carriers to start reacting and start rejecting freight. Why do you think that's taken so long? And do you think that's going to be a continuing trend after the 4th?
It was kind of like the stock market rally this year that was widely hated by investors and no one wanted to believe in, and everyone was talking about that it didn't make sense. There was this volume surge that carriers didn't really trust, and I think they didn't believe in, and they really wanted to hold on to the contracted freight that they had bid so aggressively for last year. And they've been over backwards, and in some cases may have sacrificed a little bit of asset utilization to keep servicing those customers. Meanwhile, as different parts of the economy diverged in performance, with some shippers shipping more freight, some shippers shipping less, I think their networks made less and less sense in a way. Their networks got more and more out of balance, and as they gained confidence in the volume rally, they became more willing to just reject contracted freight and try to, make money. So I think that's part of it. It's just a gradual building of confidence in carrier psychology, really.
We've been talking a lot about how capacity is going to react to volumes, but I do want to touch on volumes just for a moment, because there are, just as you mentioned in your paper, that there's a lot of convoluted data being put right now. It's honestly right. the cognitive dissonance is dizzying, excuse me. And I wanted to talk to you, and we can just briefly discuss. We have good things that are going to, and I wrote about this in the DHL Supply Chain Pricing Power Index last week, that I believe the consumer spending data, there was enough gas in the tank to keep this freight volume elevated. But I wanted to know, for you, briefly discuss or add some color on the kind of some of the headwinds that may be ahead of us on that freight volume side of things.
Yeah, I think one of the headwinds is the fact that we have a pretty undeniable wave of secondary wave of infections hitting kind of the Sun Belt right now, and it's still too young of a surge to really see how badly deaths are going to go up. But we've already seen pretty strong indications from policymakers that they're going to act aggressively to try to get the outbreaks back under control. And so things like closing bars and restaurants, et cetera. But that happened before, and I still think that one of the big things that people forget about a putative correlation between consumer spending data and freight volumes is that American consumers in normal times spend a lot of money on services. Right. And when they can't do that, they buy stuff instead. And they'll buy one kind of thing if they're excited and optimistic about the future, but they'll buy something else if they're worried and scared about the future. And all of those things have to be moved by trucks. And so to the extent that a mix shift from services to goods can be obscured by just looking at a single number of, okay, consumer spending is down. And I'm appreciative of the way that you break it up into different sectors. To that extent, I wonder how much that will affect it. I think an obvious headwind, of course, is expiring enhanced unemployment benefits. But again, does that put more people back to work sooner? What does that do for production and new orders and things like that? What does it do for the employment rate? I don't think the effect of that's obvious, and I also don't even necessarily believe that appetite for another round of fiscal stimulus in Washington has been completely stated. I think there might be another one coming.
Yeah, that was going to be my follow-up question is not only, one, do you believe there should be, and then two, do you think they'll actually follow through and be able to pull through another round of fiscal stimulus?
I think there should be another round of fiscal stimulus.
Give me them $1,200 Donnie bucks.
Yeah, Trump bucks. If the economy needs it, I think it should be much more targeted and thoughtful. I think after the generic $1,200 check to people who maybe didn't necessarily need it, the payroll protection stuff, and then the unemployment benefits, I think people have reflected on the incentives that those create and the behavior it drives. And I would hope that another round would be sort of more strategic and directed toward places where it would make the most difference, namely, I think payroll protection. And to my understanding, I'm not a policy expert. There's a lot of money that has not been claimed and has not been efficiently moved through the system to small businesses. And so I think maybe even just on the Treasury Department side and on the agency side, there might be a lot of work to do to make sure that the laws that are getting passed or the orders that are being signed are translating into sort of economic momentum.
Yeah, this is certainly something that Kevin Hill would be adamant and excited about here. He talks about it all the time, that he's, it doesn't matter how much money the Fed and the federal government pumps into the economy. If the banks aren't lending it out, if there's not enough demand for those loans, that money's just going to sit. So, yeah, well, this has been a great conversation. Let's jump ship a little bit, because I've got two long shorts that I think can fill up the rest of our time, and I think they're going to be very fun to talk about. I'm not sure if you've read anything about the two, but the first one is about a company that I do believe both of you and I are very long about, and that's Uber. There's been, it's not new news. They've been doing this since 2016 or 2017, I think, but they have recently ramped it up. Cities have been more. This has been a more desirable thing for cities to do. And basically, I'm just going to say, are you long or short the idea of Uber partnering with municipal transit authorities? And they've been doing this for a few years. Again, I think they've got, 100 or 120 municipalities that they now work with, where they basically just license out their tech to these cities to augment the transit that they provide to their people. So whether it be a late-night Sprinter van that can come along a typically run late-night highway next to a bunch of bars and take people home, either way, they're trying to fill some of those very empty buses that are running right now. What do you think about this idea?
I like it. I think that when Uber first rolled out their transit partnerships, they targeted the kinds of movements that were short and in sort of city interiors, very short distances, but slow, namely the things that aren't profitable for Uber to do. And so it wasn't like a net loss for them to kind of help cities fill that. And I think that anything that they can do to change the attitude of policymakers and sort of urban planning type people toward the attitudes that those people have toward Uber, anything they can do to bridge that kind of divide, it would be really positive.
Yeah, I'm with you on this one. I'm very long this idea. I love it for Uber. I think I think for them this is complementary and not a substitute, in which they once thought it was. They were kind of avoiding these partnerships, or very reluctantly agreeing to these partnerships, because they thought this was kind of a direct competition to them. But I don't think it's that so much. But also as an Uber holder, this is a much higher margin business. So and they run on a very tight margin industry. So I'm very happy. You got something to say?
Yeah, no, I just think that they started off with a kind of a growth at all costs mentality that was very aggressive and driven by the former CEO, Travis Kalanick. But I think that the company's gotten a lot smarter and has really embraced local knowledge of certain markets. They're in 700 cities, and they're realizing more and more that each of those cities are different, that each of those cities has different mobility needs and capabilities. And I think that they're really trying to design their markets and their services in an intelligent way. I really like the company. I think it's, whatever you can say, whatever you want about the stock itself, but I think that the company has grown far more than even some of the most thoughtful investors thought it would. And it's really created a new market and a new industry. So I think it's great that they're thinking granularly and really digging into the particularity of each market.
Yeah, I'd agree. The last thing I'd add is that as I worked for the Chattanooga City government for a year, I understood that they have widespread issues across the board. Every city does, obviously, and that every city does have different problems. You're right about that. So I'm very excited about this for every city that's involved in it. I see the buses right now when driving by my home completely empty, running back and forth. It's a complete waste to the city. So I'm very excited about this one. All right, another one I'm very excited for that we'll move forward to. It is an IPO that is scheduled for this week. They've been, it's been a long build-up to this IPO. They are an insurtech company. That's what they consider themselves. A lot of people argue that back and forth, whether they're an insurance company or whether they're a tech company or whether they're kind of some sort of marketplace in between. Either way, this company is called Lemonade. They will be. Have you heard anything about Lemonade?
No, I don't know.
Okay. Well, good. I'm excited. So I'll explain the company to you. Lemonade is a an app. They are dominant in the millennial market for insurance. You hop on, you chat with an AI bot for 30 seconds or 90 seconds, and you give them enough information about yourself, and within a couple minutes, you have an insurance offer right there, a policy there with multiple policies that you could choose from. It basically has augmented the idea of going through a massive insurance company and speaking with somebody over the phone.
We're talking about health insurance, auto insurance, tourism insurance.
Yeah. Well, I mean, all the major. They're into health and auto right now, and home insurance. I think they are expected, and their plan is to expand into almost every realm of insurance that you can go. Let me give you a couple more stats about them. Because
if I want to build like a house on stilts in Nassau, can I get homeowners insurance from this company?
Possibly so, and at least from the conversation I saw with the CEO last week, I can't remember his name, but he basically, somebody asked him a similar scenario in which a highly risky thing would go on, and he says, well, listen, you come through our chatbot, like the 98% of the claims that come through the chatbot are finished right there within a couple minutes, and if they don't, of course, they have an exception management team with real people you can speak to. But a couple real quick before I get to asking you, are you long or short? They have a lot in common with a lot of the other ambitious SoftBank-backed startups. They are backed by their major investor is SoftBank. They are pre-profit. They've got widening losses expected over the next few years, but they've got a huge TAM that everyone else from SoftBank does. And again, they're kind of like a quasi-tech company that calls themselves a tech company, but they are on a down round. They were valued about $2 billion last year. They're going to IPO at about a $1.5 billion valuation. What do you think? You think their IPO is going to be sweet or sour for Lemonade?
Man, without very much data, without even the numberless
the
SoftBank graphs, it's hard to say. I like the idea, though. I think that one of the worst parts about the insurance business from the perspective of the consumer is how hard it is to talk to people, how hard it is to get questions answered and resolve problems. So if they could build a better customer service mousetrap, I mean, they could grow really quickly and hopefully not have to, and especially, hopefully you would think young people would be a more profitable population to insure. I really don't know. But I like it. I'd say long. I would say long. Why not? Give it a shot. Other people's money, right? Not mine.
Exactly right. I'm long the company. I do think the IPO will be sour. I think that I don't know if the appetite right now. Investors have changed over the last.
Public markets maybe don't take SoftBank valuations at face value. So, I wouldn't buy it the day of. I might wait until the lockup period expires and get a couple quarters of data. But I'm intrigued.
Yeah, I mean, I think it makes a lot of sense for them. They need to go public. They need to get more attention as a national brand. I mean, right now they literally dominate the millennial, app-focused insurance market. But that's a small market, and you got to grow it from there.
Right.
And on top of that, I think COVID has really helped them. I think the idea that COVID has forced everything on the internet. It's forced but it's also awakened a lot of people to realize that some of these conversations they have with customer service representatives are completely a waste of time, and that they can be done with an AI chatbot. And one thing that makes them different than other SoftBank backed companies, specifically WeWork, in which WeWork called itself a real estate tech company, is there really was no tech. These guys actually do have a proven, really capable AI chatbot that can answer almost every question within seconds. So they do have some proprietary tech.
That's interesting. That's cool. I like it. I wonder how they manage their float and how aggressive they are. One of the other big problems with WeWork is that it had long-term liabilities and short-term assets that were volatile, and long-term liabilities that did not change, and they were buying at the top of a market. I wonder how that mix of liabilities and assets looks like for Lemonade. Yeah, we will see. They'll be IPOing this week. I'm very excited about it. I think the Robinhood traders are going to hop on it. I think they're going to go wild on it. But JP, my man, thank you for joining me today. You held down the fort with me. And I guess, what are you guys working on this week, by the way? Just on a quick note, you got about 10 seconds. Yeah, we are working on some TMS stuff, actually taking a deep dive into that industry, trying to separate the wheat from the chaff, and really figure out which of these companies are good at what. And that sort of thing. All right, some TMS stuff. Yeah. Well, all right, everyone. Thank you so much for listening. 6-day, 23.5-hour break. See you next time.